Well, the euro falling after the ECB announced it will keep rates unchanged until the summer of 2019, but they will taper in December. We're about half an hour away from that press conference with Mario Draghi, where the ECB will discuss ending QE for that first time. Joining us now, Mark Okada, Highland Capital co-founder and CIO. Mark, great to see you. So the trade into the meeting, long euro, short bunds. What is it now?
Well, I think as we think about the European situation, it's much more complicated than here in the U.S., given how big the bond program has been versus the size of that market. They have swamped that market with their liquidity, and so any changes to that going forward are going to be reflected in some of these markets that we look at. I think what's happening, and it's very interesting to see that global growth is turning over a bit in Europe, and the numbers have gotten softer at the same time that we've got an announcement finally that they're going to get out of the market. As far as the market's concerned going forward, I think you're going to see some widening as far as credit spreads across the theater as they pull back eventually. But the good news, I guess, is that they kept the rate hike a bit pushed off, which should keep conditions, at least from a rate standpoint, fairly benign for quite a while.
Mark, would they have announced what they've announced if they had real concerns about sort of a turning over in the rate of growth over in Europe?
I think you're right about that, David. The numbers are turning over from a very high point, right? We had that big boost last year across the global economies, and so a little bit of softening here, given the rhetoric on trade, given the fact that you've got some real issues, I think, popping up in the emerging markets, kind of makes some sense to us to see some of that softening. But it's not something that's at the alarm stage at this point, where you'd see them maybe reverse some of the decisions that they made. But I think it's the end of the bond buying program is actually a good thing for markets in the long run. You got to remember that they have really manipulated the rate market in Europe and the currency market by being such a big player.
You mentioned trade. List both trade and Italy as possible, if you would, geopolitical risks. How much is that dampening what's going on in Europe?
Well, I think it's the picture's complicated, right? We have sort of a pivot going on between the U.S. and the China relationship, and as China, I think, looks to pivot its economy more towards Europe over time, that will be a positive for Europe. But on the other hand, this sort of protectionism coming out of the U.S. is a net negative for both situations. So I think it's a net negative overall. I think you could continue to see some pressure. We've got rates rising in Italy, which makes some sense, and that certainly is a negative, a net negative. So, but again, these are all happening at a time when the numbers are very strong, and so I don't think it's time to get too excited about this.
We are seeing, though, some strong buying over in the European market. Quickly for Europe, before we move on to the Fed, what's your favorite Europe trade right now?
I think we like. I think we like the dollar versus the euro. I think that the dollar continues to strengthen against the euro for a while here. That would be kind of our call on that.
So it was a tough call. I could say, see you sweating there. So if that's the call for the Europe trade, let's go then to the U.S. and what we heard yesterday. Particularly want to point out what Jay Powell, Fed chair, said about the yield curve.
We know why the yield curve is flattening. It's because we're raising the federal funds rate. It makes all the sense in the world that the short end would come up.
Makes all the sense in the world, but you can't escape just how flat we're getting, Mark. If you take a look at the Bloomberg terminal, 210s, 530s continue to flatten today. TD Securities sees the 530s hitting 10 basis points by the end of this year and 210s hitting 20. What's your call and what's the trade for you?
Well, we're in the camp of rates higher across the board, so the flattening that we're seeing is not something that we would be think would last per se. I think overall rates need to move higher across the entire rate curve. given where inflation is going. I mean, we talked a little bit about oil earlier on the program, but I think that that's going to continue to put pressure on inflation numbers, certainly the wage situation, and the strength of the U.S. economy. I think it really hasn't seen the benefit of this tax deal yet in any meaningful way. And that's really, I think, the biggest divergence that we see across the U.S. Theater, where you have this massive increase in fiscal at a time when we are at very, very tight employment levels. The punchline there has to be that we see more inflation. I think that means that the back end of the curve starts to back up too. So I think this flattening that everyone is worried about and leading to some sort of recession is not our call. It's not something we see across any of the corporates that we're lending to at Highland, or the equities that we're involved in. The corporate economy looks very strong in the U.S. per se. So I think the flattening of the curve is certainly something that people are getting very concerned about, but I don't think it's a recession signal. I think Jay Powell's right that they're raising short-term rates. That's creating a lot of flatness in the short run, but I think we're going to continue to see rates rise on the back end and probably a bit of a steepening from there.